Greg was just reporting some serious green on the screen. S&P up 1.5%, the NASDAQ up 2.2%. I don't know what to make of it. Is this the end of kind of this malaise we've been in for 2022, or is this kind of a dead cat bounce within a greater bear market? Phil Palumbo, he's a founder, CEO, and CIO of Palumbo Wealth Management. He's been in this investment game for a long time. Love to get his thoughts here. Phil, we're going to have a good week here as we start the summer here, Memorial Day weekend. What do you make of this week's trading vis-a-vis kind of what we've dealt with for so far in 2022?
Yeah, what I'm looking at is more thinking the Fed, if you think about what he said, the words that he used was softish landing. Others are using hard landing. I believe it's going to be a crash landing. As I think of things, and you think about the things that he's embarking on in terms of the tightening cycle, he's raising interest rates rather aggressively. He stopped purchasing bonds in March. They're going to let bonds roll off the balance sheet in June. So we're talking about a tremendous amount of liquidity that's going to be coming out of the markets that's really going to impact the economy in a major way.
Has that been priced in? Some folks were suggesting kind of coming into this week, maybe a lot of that's priced in. If I look at the minutes, it's not going to be maybe as bad as we initially thought. That seems to be a little bit of a bullish call that kind of got some life this week. You're not buying it?
I'm not. The consensus seems to be in the camp that we're going to go into a recession. So I think people are starting to think of things that way, and I think some of that's being priced into the bond market and some into the stock market. But there's been more to go. Anytime you go into a recession, the peak to trough drawdown on average is 35%, somewhere around there. So there's definitely more room to go in terms of where we could potentially be. I think the big question now is more, is it going to be a mild recession or is it going to be a prolonged recession? I think that's more of the question that we're thinking about more than anything else.
And kind of what is the data suggesting to you? What is your experience suggesting to you as to that issue?
Yeah, when you think about money supply and how much money has been injected into the economy since 2008, and obviously more so since COVID, and that's, we've been so used to this stimulus, and it's got to change. And we just can't continue functioning properly, both here and abroad, right? So with these three things that the Fed is doing now, like I just talked about before, we're talking about a major strategic shift that if he's strong enough to do what he needs to do to create a more normalized economy like we saw before 2008, a lot of damage would have to be done. A lot of correction would have to be done. So I think bringing the S&P to a forward multiple of around 14 times probably makes sense in light of the risk that we're experiencing now. You extrapolate inflation on top of that.
How about some of the bullish data out there that people will cite, whether it's the labor economy, low unemployment, wages rising. We got the consumers are still spending money. And maybe even inflation might have already peaked. That might have been in the rear view. That would suggest some maybe the worst is behind us.
So the bulls are saying exactly that, right? The consumers are strong, corporate balance sheets are strong, the banks are strong, and consumers are spending, and earnings look pretty good, right? So yeah, that's true if you look at the past data. And I'm not concerned about the past data. I'm more concerned about what things are going to look like third, fourth quarter, first quarter of next year. And I'm thinking more about the low-end consumer, mid-tier consumer, how they're getting hit with inflation. I just think all of this is going to add up to a slowing overall economy. I don't buy into what the bulls are saying. I think they're missing out on the excess inventory buildup that's going to be problematic. That creates a classic recession on top of everything that I just discussed. I think they're missing a lot.
All right. So what's an investor to do? You've been in this game a long time at Morgan Stanley, Merrill Lynch. Kind of what are you telling your clients right now as to the next 12 months maybe?
Yeah, so a couple things, right? So one, I believe what Wayne Gretzky says, go where the puck is going, not where the puck is today. Yeah. So as a firm, we de-risked in 21 coming into 22. So for example, we're 18%, 15 to 8%, 18% cash.
Really?
We're 7 to 9% in gold, 9 to 12% in commodities, and then we have equities, which are around 30 to 40%, and then fixed income, which are treasuries. So we've done our job in terms of de-risking, right? We're not timers and not trying to figure out when the market's going to bottom or top or whatever it looks like. So we've done our job de-risking. Now what we're thinking about, using the Wayne Gretzky phrase, is now when we're saying to ourselves, when are we going to add risk? Because there's incredible opportunity today, and there'll be even more better opportunities as the year goes on. So we're more in the camp, let's start bringing risk on the table, but slowly do it.
It's interesting, we talk about maybe adding some risk. Some of the, you talk about NASDAQ being down 25% plus at its nadir here just a couple of days ago, but some big names like Amazon and Meta, they were also down 30, 40%. I mean, names that you just wouldn't expect because they got real business models, real earnings, real cash flow.
Right.
How do you think about some of those tech names?
I think overall it's just a slowing that's going to occur. 70% of GDP is the consumer, and if the consumers are slowing and it can continue to slow, consumer sentiment is going to continue to slow. Companies like Apple and Amazon who sell stuff, their revenue and their margins will slow. Wages are increasing, which will hurt margins. And these are the reasons why these companies are trading downward. Apple really, there was an anomaly in 21 with Apple, but technically, if you look back the past 5 years, their revenues hasn't grown tremendously. In fact, you could argue that the rate of change growth has slowed within Apple. So, is Apple and Amazon, have they peaked as companies, and they more like cash cows like Coca-Cola and Pfizer? Where's the growth going to come from these companies? And so you have to reprice these companies. So I would suggest that the forward multiple of Apple is probably wrong, and it's got to come down. And same thing for Amazon, which is trading at a forward multiple of 70 times. Yeah, they're great companies and all that stuff, and I believe in quality. But listen, the Nifty 50 was a great story back then, and they got crushed. And kind of the thing may be that similar story.
All right, Phil, great stuff. Really appreciate getting your thoughts and your perspective. I think it's a little bit counterintuitive, or not counterintuitive, but counter base case out there for that. So I think a lot of investors appreciate getting your view. Phil Palumbo, he's a founder, chief executive officer, and I'm going to call an investment officer as well. Palumbo Wealth Management.